trade sentiment cycles. You know, if you deal about cycles, cycles mainly detect the emotions of the people, the mood of the masses moving up and down, the fear in the market. So cycles is a great measurement on detecting emotions. So when emotions flow within cycles, they move up and down in the form of waves. There's no abrupt jump. So the cycles approach has a great idea on applying this to sentiment index. So instead of using the primary index like Nasdaq or Standard & Poor's, which I showed you just with the last examples, you should think about that there's a lot of market data out there which tries to measure fear. So for example, if you think about the American main index like Standard & Poor's, there's a so-called volatility index, the VIX index, which measures the fear in the market. So what you can do with this cycles approach is just apply the cycles approach to measure the fear in the market. And if you detect major turning points in the sentiment, you would expect a turn in the market. So, and therefore, I will show you the same last 4 to 6 months with trading sentiment cycles. So what I did before, it was the price. Now let's move on and have a example on sentiment cycles now. So what I will show you here is one of my favorite examples to trade sentiment cycles. We will go over the full period of 6 months review bar by bar to show you this dynamic trading cycles technique. What I've opened here is a chart for the Standard & Poor's 500 daily index, where we start in the beginning of March of 2012. So we will use the full period of the last 6 months to have a review on this period. And here down below you see the chart of the VIX index, the volatility index. This is a so-called fear index, and this can be greatly used to measure the sentiment in the markets. So in general, the VIX index is correlated vice versa to the market. So a top in the volatility index, which corresponds to a high fear in the market, corresponds to mainly market lows, as you see here. And lows in the volatility index correspond to major market tops in the markets, which you can see here. So here we have a major low in the market and a major top in the volatility index. And here we have another low and another top in the volatility index. Here we have a low in the volatility index and a major high in the market. So it's vice versa correlated to each other. So a trend shift in the volatility index will indicate that we would expect a trend shift in the market here in the S&P index. So this is mainly the idea. On the other hand, it's hard for the VIX index to work with standard technical indicators. But if we apply our cycles technique, which I've shown and explained already, to the volatility index, this will be of great benefit for us. Just because in the end, the dynamic cycles approach is used to measure the timing and not the absolute values. So what we will do now, we will just apply the standard cycle indicators to the chart, just using the standard settings and applying it here just on the chart. So this is the basic setup. What you see here now is the dynamic cycle explorer plotted for the volatility index, so completely independent from the price. And here in the upper chart you see the Standard & Poor's index. We will just add a standard momentum indicator just to confirm the prices here. So what we will do now as trading technique, we will follow the dynamic cycle of the volatility index to forecast the next major turning point in the market, and then we will trade the price movement. So we will trade price according to our forecast from the volatility index. So this is what I want to show you now. I just want to make the Standard & Poor's index, our primary trading index, a little bit larger. And now we will have a look on these indications here. So what we would expect here is that we don't have a market top. So this top in the volatility index normally corresponds to market lows. So actually this would not be a top, this would be a low in the market somehow. And you see that the detected cycle has a great correlation to the past if you just watch this major cycle which has been detected here. So just to review and validate it, we have a cycle top here which is a market low. We have a cycle low here which corresponds to the market top. We will then have the cycle top here which is the market low. We will then have the next cycle low here which is this market top. We will then have this cycle top here which corresponds to the price low here. So we have a great alignment in this dynamic cycle here which is detected on the volatility index. So we have a great alignment between the cycle with a length of around 50 bars and the price behavior. So it's fairly clear to follow this cycle into the future here. And the next projected time window is the beginning of April for the next major top in the market. So a low here in the dynamic cycle on the VIX index will expect a major top here. So we will just follow this projection and go forward bar by bar as new data will flow into the market here. So we will process bar by bar. You see new bars are coming into the chart. You see we follow this low here. Now we see that this expected low is shifting more to the left, which means that we will expect the market top to come a little bit earlier. So now we're approaching this cycle low here, so the amplitude is not the major thing, and even it shifted to the left, you see the length of around 50 is still the same. So this is still the same dominant cycle with around the length of 50 bars. Now the expected low shifted to the left. We are now approaching the low, and what we do now is we monitor price and momentum closely. So we can now expect a turn in price with correspondence to a major market high here. So we will go forward bar by bar, and what we see here now, we are exactly on the low of the current dominant cycle, which should correspond to a market top, and we see momentum top here. It just turned down at this price top. So the normal indication here that we would have our expected top in the market here at this point in time. So then we will move forward in time, and our next expected window would be here somewhere in the beginning of April for a top in the volatility index, which should correspond to the low in the market. So we will move forward bar by bar. You see the cycle shifts, and the turn was right on time. The market turned down. So and the next expected low here should be around mid-April. So we will go forward bar by bar. What you see here is price moved up, but we have a nice divergence here on the momentum. So we are still at the expected top area, which is the down area here. So what you can do is you can load up your shorts here at this point in time, because we are expecting a major turn down into the beginning of April based on this divergence here. So then we will process forward as we expect the low to come somewhere here in the beginning of April. So the cycle stays very stable here in our example. We are just approaching into the expected window here. Price turned down now. We will just follow the dynamic cycle, and as you can see, price comes down nicely into the expected bottoming area. Now we have to watch price and momentum closely for a turn in this area, and this is exactly what happened here. So what we can expect here is that this would be the major low, which we expected already. So this would be the point in time where we would set up our long trade and close the short trade. And the next expected cycle or sentiment trend shift should be expected in the beginning of May, which should be a low in the volatility index. So we would expect the next top at the beginning of May to come. So let's just move forward bar by bar in time, and you'll see we have passed our expected low window here, and price is just starting to move up, and we will just wait until we come close to our expected topping window, which is in the beginning of May. You see the cycle shifting a little bit again, but it's still a very stable cycle here. So now you see that we are moving into our topping area here already. You see that price already turned down and the momentum also at a very high level. So this would expect that you should close the long trade and can start to go short again, because now we are arrived at our projected down window and momentum and price just turned down. So the indication is price at the expected time window here. So trade price, not only the forecast, but if forecast comes into alignment with price, that's the exact time to trade now. So we have our expected top here again based on the cycle low on the volatility index, and now we can move forward in time. And the next expected shift would be expected in the beginning of June with the cycle top here. So we expect the market to bottom in the beginning of June. So we move forward and monitor just what the market is doing. So we see a light shift to the left here, but still expecting the cycle low here at the end of May, beginning of June. So what we should do now here is we start to monitor price here somewhere in this area. Still some days to go into this direction here. So we're now starting to move. We're coming into the beginning of June into our topping area. But here's a nice situation. From the cycles you would expect now the low, but the momentum is just very high. So we should wait until the momentum drops in this area here. So this is not the right time to go long in the market here. Even if we arrived at the top, we should wait until the momentum comes down. So we will just process a little bit forward, and you see exactly at this expected time window here, momentum comes down now, and the next turn in this window here, so if the momentum and price goes up, this is the indication and the signal that the low has arrived, which is exactly the situation here. So momentum turned up, price started to turn up, we have a low situation here from the absolute values, and we are exactly at this expected top of the cycle, which should correspond to a market low here. So this is the exact time to place the next long trade here. So now we move forward in time, and as you can see, the next expected time shift would be at the end of June with the low and the high in the market. So we move again forward in time until this window will arrive. So, and as you can see here, we are arriving now at the expected low, and this should be a market top here, so we closely follow price. And what you see here is the momentum. We have a divergence here, which is a bearish indication. So we would just wait until price turns down, which is now the case here, with a divergence setting up here exactly at the cycle turn. So this is the exact top which we expected at this point in time here. So this is now our top projection here. So, and again, we just move forward in time. The next expected time of arrival should be somewhere in the middle of July as we process forward in time now again. And you see market comes down nicely here at our expected window, but we will just move forward until our next expected time window just arrives. So now we start to come closely into this direction here, so a market top. So we would expect here somehow a major low, which might has been coming here. So you see here, this is a hidden divergence, a higher low, and here more a lower low in the momentum index. So we would expect the market to turn up based on momentum and price, and the market is at the expected bottoming area or top of the volatility index. So this might be an allowed low already coming here into play. We are at the topping area here, so which is the bottoming area of price, and momentum just turn up. So now our next expected point in time would be here in the beginning or in the middle of August, which is cycle low, which should be a high in the market here. So we move again forward bar by bar into this area, and you see here this was the exact bottoming area, and now price turns up as the cycle goes down, which is exactly what we would expect. And you see again the cycle is very stable here, just shifting slightly, but we will follow the dominant carrier wave here. And now we start to come into our topping area here. So now we start to move momentum and price closely. We already see a divergence here between momentum and price. So we watch closely now the expected top to come. We just have to wait until price starts to turn down based on the divergence and the expected area where the turn should arrive. So now you see here price is just turning down. We have a divergence and we exactly expect at the expected top of the market, which is the low in the cycle here. So this is exactly the time where we would expect the market top here, and now go forward with the next expected low in the middle of September based on this projection here. So we move forward. You see nicely that price is coming down as projected here, but we wait until our next window will arrive somewhere in the beginning of September, where we would expect the market low. So we monitor now price closely. As we see, momentum just goes up. Price is still in the same range, so we have to watch closely now. And if now price starts to pop up, which has been done here, we know this is the time to go long or the time to close the short trade again. So we had the expected top here on the cycle, which is the market low, the expected low, and momentum turns up. So now we move forward again, and we would expect the market top to come in here in the beginning of October. So we move forward bar by bar, and as projected, market goes up now in this area here where the cycle turns down. Market should go up exactly as projected, and now we just move into the expected area where the top should come in. So as we arrive at this area, you see momentum is very low. So what we do here is we wait. Momentum should go up again into this timing window here, which is now the situation. So this is not the exact time to go short here in the market. We have to wait until momentum turns up and comes down again here in this area here, which happens now. So we will just wait until now the momentum tops out, price tops out, which is exactly the situation here in the expected cycle turning area. So this is the exact situation where we have the next expected top in the market. Let me just highlight it here. So here's the top, and now we would expect the market to come down, which is exactly as projected here. So this is a situation just today, as you can see based on the cycles. So what you see here are the turning points just detected by following the dynamic cycle of the volatility index. So we did trade the market here based on the VIX index and the dynamic cycles we detected on the volatility index here. And you see, as we are at the end of the cycle length is still the same within the range of 50 bars, and we just follow the dynamic shift of this sentiment index here, which gave us clear direction here in regard of the cycles. We will just just mark it a little bit to make it more clear here on the chart, which is I think just a nice example how this approach works. So the highlighted shifts here would be our expected trades. So okay, so just to zoom in into this example here, yeah. So this would be the final review. So what you see here is the exactly how we would have traded the market based on sentiment cycles, and you see how nicely we would have been able to time our trades just based on sentiment cycles here. So the trades and the cycles have not been detected by price on the S&P index. The detected cycles have been done by the sentiment index with the VIX index. So this is a nice combination I wanted to show you in combining a dynamic cycles trading technique which a market approach. So you follow the dynamic behavior of sentiment cycles and are able to time your trades very easily on the main index here, which you can see clearly now. And this is the behavior of the last 6 months in the market with a non-interrupted example here live on the chart. So this is non-interrupted, this is not cherry-picked, these are simply the last 6 months with the standard cycles tools. I think this shows you the power of the dynamic cycles approach.